please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Is Bazaar Morning Call live from the CNBC TV18 headquarters in Mumbai.
Good morning. Welcome to Morning Call. I'm Lata Venkatesh. With me are Anuj and Surabhi. Well, actually, it looks like for the last 2 or 3 days, the global markets are doubting the extent of the global recovery. And today, that's very stark in the way commodity prices have moved overnight. We saw crude kind of receding from the $64 mark, but yesterday was a sharp 2.5% fall. And that's kind of mirrored in other commodities. Copper, zinc falling 2%. Shanghai steel has fallen about 5%, 2%. And nickel, again, falling by a similar percentage. So it looks like suddenly there are some doubts over the intensity of the global recovery, not the story of global recovery itself. As well, you can see the same thing in equity assets. Over the past 2 or 3 days, we have seen consecutive falls across markets, Asia, Europe, and the US. But this is coming at a time when we've got fairly strong Japanese data. So is it that the market is just shaking off temporary excesses and will resume its upturn? We will have to see. For India, of course, the growth worry is also coming from the fact that we don't seem to be yet participating in the global recovery. Our export numbers are bad.
Absolutely. I don't know how to cut it and sound any more optimistic, but Lata, I think you've started off on what is a fairly realistic note, because we have to look at a lot of these negative cues. The results are already on the screen, whether we saw the closing on Wall Street overnight or the way you're looking at Asia, pick up that. So it's one feeding off the other. US worries, and on the Asian side, then you've got, of course, Chinese numbers if you still want to hold on to that data. The SGX Nifty is down about 3640 points. You'll get the regional markets up on your screen. So the color is very truly red. And really, as Lata's already pointed out, it is that Chinese number on industrial output, on retail sales, that kind of triggered this off in the last 24 hours. We are going to talk a little more about crude as well in a bit. But Anuj, good morning. I mean, technically, where does this leave us? We were anyway discussing this whole fight to hold on to, this level of around 10,200, where the bulls pretty much were failing yesterday.
Morning, Surabhi. It's not just about technicals. Look, market is smarter than all of us. And the market knows that this data is showing up now, and that's why the market's been going down. The market rallies ahead of good numbers. The market, falls ahead of bad numbers. This is, because at the end of the day, the market preempts data and mostly does not react to data. I mean, just look at the last 7 days now. You're discussing this. The fall in Indian market started from November 6th, even when the global markets had not started falling. And from that day, consistently, every day we have made a lower high and lower low for the market. And in fact, yesterday's was really distinctly weak. You keep going down the data and see November 10 onwards. November 10 was Friday. We thought that maybe that cycle is over, but far from that. On Monday and Tuesday, once again, lower low for the market and lower high for the market. Chances are that with the SGX Nifty indicating a gap down, and because we closed already at yesterday's low, we will have another Nifty low today. And unless we have a 100 point rally from the low point, another lower Nifty high today as well is possible. Having said all of that, this is a bull market, and in a bull market, this has been a tradable correction, but you don't try your luck beyond a point in short trade in a bull market. Usually this lower high and lower low cycle lasts for 6 or 7 days. We already have about 7 days, and the Nifty is very close to 50-day moving average of 10,100, already below the 20-day moving average. FIs are adding a lot of shorts for last many days and covering a lot of index longs. In fact, the FI long exposure is now down to 51% versus a peak of 90%. Anecdotally, when FIs become net short on the market, which is almost there now, right? I mean, 51 versus 49, almost net short. That's the time when market actually bottoms out. Time is right for market to bottom out. Maybe crude becomes a trigger, because that was the first trigger for market to fall. So maybe the market latches onto that. Also, the US market recovered intraday. Yes, they closed in the red, but there was a 150, 180 point recovery in the Dow. So I think things could improve. As I've been saying, and you'll hear it a lot more over the next 1 month about Gujarat election. That is something which is dominating mind space now and will start to dominate headlines as well. And just one more point, India VIX is at 14. The volatility index, it's from 10 to 14. It's shaken out a lot of weak hands. The recent high was 15 when the market bottomed out. These things have a habit of repeating themselves. I think we are very close to a bottom for the market, very close to ending that cyclical correction in a structural bull market. Chances are that if you buy now and in this zone, a month from now, 2 months from now, you'll be sitting happy and making a lot of money.
You know, completely, because that's what the pattern has been in the past. Let's see if that pattern repeats, because we've not seen more than a 3.5–4% correction, and we're already down to 3% from the top. Just an additional point, Anuj, because you mentioned oil. The report that came out from the International Energy Agency yesterday was extremely bearish, which should technically mean great news for India. They said a couple of things. Quickly to round this up, they're expecting a glut to come back. Now, we haven't heard the word glut in almost a year in the market since the OPEC cuts came through. They are saying, despite the OPEC cuts, because shale production is so strong, expect a glut back in the market in the first half of 2018. Winter demand is slightly weak, and they've lowered the consumption target by about 100,000 barrels a day. Let's see. I mean, November 30 is the OPEC meeting. How will they respond? And then where the market goes, we don't know. But I guess, Lata, we're trying to clutch on to straws here because the way the bulls have been completely pummeled in the last couple of sessions. But now back to the domestic issues and the macro numbers, the export numbers that we got yesterday. Should one be worried?
Well, they look bad because it's a contraction. I mean, exports have fallen year on year. It's $23 billion. Now, you know, if you looked at the year-to-date data, average on a month, we've been doing 22–23 billion, which is mediocre by Indian standards. At the height of global trade, we used to do 28 billion. So in September, we did 28 billion. And therefore, the feeling was, okay, we were not participating in the global recovery because of first demon and then GST disruptions. But now the supply chains are in place, and September looked okay, though there were a fair amount of skeptics. Now, when October goes back to 23, you just worry, which is the outlier? Was September the outlier, or is October the outlier? And we will come back to, the point is we are not participating in the global recovery, and that is a bit of a worry. There are some optimists who think that it is, the October data should not be treated as very worrisome. I'm not worried about trade deficit and stuff like that. Even at 14 billion monthly run rate, we have, you know, we will still be south of 2% in terms of current account deficit. So we don't have any macro worries over there. But, you know, you have to participate in growth. So that not happening is, for me, still a worry. Credit Suisse says that probably October is an outlier. I would be very happy if they are right. But, you know, at the moment, I was desperately waiting for the October exports data. If it is as good as September, then clearly, you know, our global trade, our participation in global trade is a given. So for me, that disappointment was very stark. So now we really will have to wait for November data. But the minor positives in what you were mentioning, crude is not falling for want of demand. Crude is falling because shale is catching up. Now that's positive. Whereas for the other industrial metals, I would still worry that they are, you know, they're worrying they're overpriced for current levels. For crude, it looks like, you know, it's just that shale is now catching up, and that's a positive. The other positive is that we were all seeing yields rise. Even today, the Chinese yields have hit some 3-year high, and Indian yields went to 7%. If you have this commodities peaking off at these levels, then that no longer remains a challenge. You know, I don't see yields climbing beyond 7% too much. It'll see you know, bond
some
buying at that
perhaps.
level, which again would
good
be
for
positive.
banks, perhaps. All right. All right, let's actually expand on that Credit Suisse call. Here's a note coming in from Neelkant Mishra. He says the BOP surplus in the last several years has been $15 to $20 billion more than the rise in the oil import bill. He says an improving global economy likely means the October export drop was a blip rather than a trend. However, he adds the fog on the economy now extends to the currency as well.
Okay, let's wait and see. I think the jury is out, and we should not be coming to any conclusion on, you know, exports. Let's get money market views. Pramit Brahmat of Veracity says the rupee will trade with a negative bias on the back of negative cues from the domestic equity market. He expects the spot USD INR trade to trade in a range of 65.20, 65.80.
And now to the bond market, where all the headlines were being made yesterday. Dhaval Dalal of Edelweiss AMC says bond yields continue to trend higher amidst rising inflation and unwinding of positions. He says the sentiment is weak amidst continued supply pressure and uncertainty on oil prices and its impact on inflation going forward. He says the market participants are unwilling to build positions despite yields looking attractive. He expects bond yields to remain range-bound in the near term in the absence of any positive triggers.
Okay, US market ended down, but there was quite a bit of recovery in late trade. Here's Mangalam with the world view.
That's right. The Dow ended with a cut of close to 30 points. But remember, at one point in time, it was down around 150 points. So there was a sharp recovery. Despite that, we saw a bit of red across the Wall Street in yesterday's session. And that red was led lower by GE. General Electric, remember, is at its lowest level since 2011. In the last two sessions itself, that stock has lost 12%. Remember, they had weak earnings, and the street was disappointed by the restructuring plan that the company proposed. Across the Atlantic as well, we saw some red across the main indices, the FTSE, CAC, as well as DAX. That was led lower by basic resources. The likes of Anglo American, Rio Tinto, as well as Glencore, all of them down anywhere between 1.5% to 2.5%. But a lot is happening in the FMCG retail space. Tesco has made a bid for Booker Group, which is a wholesale group company. So both stocks surged about 7%. But the German company Henkel, they are not too happy with the consumer growth prospects, and that stock fell about 4% in yesterday's session. Asia, well, we saw some strengthening on the dollar yen on the back of strong Japanese GDP data, because of which the Japanese index is lower, puts all the exporters at a bit of a discomfort. We're seeing some red across Kospi, Shanghai, as well as Hang Seng. Shanghai, remember, the bonds are at a 10-year high, the yields that is. The SGX Nifty on the back of that indicates a cut of close to 0.3%.
All right. Thanks, Manglam, very much. Fair enough. We have noted that the global screen is looking a little challenging, and that translates into a 30-point dip for the SGX Nifty right now. But what about individual stocks? As earnings season is wrapping up, we've got lots of stocks moving on numbers, and of course, there are others moving on news headlines as well. The team is here. Good morning, guys. So, Anuj, let me start with you. What's on your radar today?
So, I'm watching out for three stocks actually today. First is Mahindra & Mahindra. It's a stock which is gaining ground after a long time. So, it'll be 6% up this month, while Maruti is down 1% this month. It's correcting its massive underperformance versus both Maruti and Escorts actually. This year, M&M is up 21%, while Maruti is up 53%, and Escorts is up 138%. I'm taking these two stocks because, you know, M&M has both businesses. So, obviously, tractor being the larger component. So, let's see if there's some more catch-up. The other is Ujjivan. I don't know. I mean, there's something up with the stock. Yesterday, it bounced from 200-day moving average. And stocks bounced from 200-day moving average and with delivery-based buying for many days. Generally, there's a corporate event around the corner. I don't know if there is, but that's something to watch out for.
It's a lot of M&A talk.
Exactly. So, but since we don't have any information on that, so
there's no confirmation.
Not fair on my part to say that, but I can just rely on the data. And finally, Jet Airways, I mean, it's a stock that I've been flagging off for some time now. It's out of F&O ban, and there's an analyst meet on Monday, I think. Oil is down. So let's see if there's any follow-through on that.
Okay, thanks a lot for that. But today, I think equally important will be the pharmaceutical companies because of news, results from Sun Pharma and news on Lupin. Ekta?
Yes, absolutely, Lata. And you know what stood out for Sun Pharmaceuticals yesterday was that the margins have recovered to 20% versus 17% in the previous quarter. Now, in terms of the conference call highlights, the management did say that FY18 guidance will be maintained in what is a challenging environment. So that would imply around a 15% growth in second half over first half. So let's see whether that culminates or not. Halol, they are still waiting for a re-inspection to take place. They've re-invited the US FDA. They did acknowledge that the Baska site, is getting inspected, but they don't have any clarity on whether Halol would be inspected after that. So that would still be a moving part. I do expect the stock to probably be a little bit in the red because the US continues to be a challenging environment as the sales were down over 20% on a sequential basis.
Okay, so that's Sun Pharma. Let's see. We'll watch out for that. Now, speaking of FDA woes, what about Lupin? What does that warning letter contain?
Well, we already know that. The company has got a warning letter for the Goa as well as for the Indore units. Now, the details of the warning letter were out overnight, and it did mention a lot of what Nilesh Gupta spoke about on the call, which they held post, the news last week, where there is repeat observations which have taken place on the two sites with regards to out-of-specification studies. So what you can see is that maybe a lot of technical work which Lupin probably has to do over the next 6 months to a year. So we could probably see a delay in US approvals. It's a reiteration of something which was probably factored in last week itself. So maybe incremental negative simply because now it's probably just going to be a reiteration of what we already know.
Okay. Ekta, thanks a lot for that. So that's Sun Pharma and Lupin to watch out for. But stock of the morning trade could be Bank of Baroda, and the numbers did look good, Abhishek.
Well, Anuj, it's an all-round performance given by Bank of Baroda. Look at the slippages. The slippages were the lowest in last 4 quarters, and in the current quarter also slippages declined by 33.6% on a quarter-on-quarter basis. The overall stress in the portfolio, that is the net NPA plus restructured book, actually declined to 8.1% versus 8.3% Q-on-Q. The domestic loan growth, which was at minus 11% 4-5 quarters back, is now at plus 13.8%. So that is very heartening to see, and that has actually led to improvement in domestic net interest margin, which at 2.68% is the highest in last 4 quarters. The gross NPA also reduced to 11.16 versus 11.4% on the back of improvement in the asset quality picture. But provisions remained elevated, and that is why we saw profit down by 35%. Provision coverage ratio improved to 67%. So UBS, the brokerage recommendation is that UBS has upgraded their target price to 230 from 220, and Credit Suisse also maintains an outperformance rating with a target price of 200. Expect the stock to do well in trade today.
Oh yes, and no two ways about that. In fact, I would just go further. I think the PSU bank numbers, even if you include PNB, SBI and BOB, the big boys, BOI as well, clearly indicating that probably they are in healing mode now. That will be positive, and the fact that crude has fallen off and global commodities are sulking is going to mean yields will peak off. Today I see those two areas, NBFCs and PSU banks, definitely in a fine spot, or at least outperforming, even if the market were falling. And speaking of NBFCs, Indiabulls housing should be a top of mind recall.
It will be, I think it's a big deal coming in from Indiabulls Finance. Just remember November 2015 when the deal was announced that they will be buying stake in Oaknorth Bank. The stock went down by 15%. Now what has happened is that they have sold 1/3 stake in this bank for 770 crores, 1/3% stake. Remember, they invested 663 crores in the entire stake what they bought. So they've already recovered much more what they invested, and they're still left with 20% stake in Oaknorth Bank, the value of which is nearly 1,500 crores. So in 2 years, they've recovered everything in it. So if you have to go by book value, analysts tell me that this money post-tax will increase the book value by 4 to 5%. In this assessment. So I see green on the stock today.
Okay, green on it.
Certainly green on the stock, but I would still be wanting it to be greener if it made the money on its traditional known business. Now we don't know. Oaknorth ended up being good, but you're investing in a company expecting it will do very well in housing finance. Now, suddenly they come up with an investment. I don't know how many investors will be comfortable. Good, this one paid off.
Yeah.
But you should be making money on your conventional business, the business for which I'm investing money.
They're doing that as well, to be fair, Lata. So, and the stock, of course, has done well, and now a nifty stock as well. Let's stay with the Indiabulls group. Sonal is watching out for Indiabulls Real Estate.
Well, weak set of numbers, Anuj. The finance costs continue to be a big problem for the company. Though the revenue was up 2%, majorly because the commercial business did really well. The EBITDA margins expanded by 1,600 basis points because of the cost control measures that the company has taken. However, the profitability went down because of the higher finance costs, which were up around 37% year-on-year. Debt continues to remain a problem. It has increased to 9,400 crores as on 30th September versus 7,500 crores as on 31st March. So I expect a red on this stock today.
Okay, all right, Sonal, thanks. We'll watch out for Indiabulls Real Estate. And speaking of debt concerns, we are back to Reliance Communications. Now, Lata, yes. What is the latest?
Well, the latest is that they've defaulted on a bond, a 2020 global bond, dollar bond, and that grace period ended on Monday. This is, of course, international agencies reporting from Hong Kong that this default has happened. Now, until now, international lenders had no other option but to take the company to liquidation. Now they can come to the bankruptcy court. So we will have to see how international lenders react. But it is an immediate setback, not just to Relcom, which already is showing all the pain of the debt, but to banks like SBI and including BOB and PNB. The good news will be taken off. SBI is a very big lender to Relcom, and therefore you should expect some setback on those stocks.
Okay. Well, from Marcom, let's move on to JP Associates. Anisha, Interesting. I mean, the finance cost is declining, is it? What's happening on the operational side? Any improvement at all?
Well, yes, it looks like that the debt woes of the companies that you were talking about is abating a bit, because look at the finance cost. That has come down to 181 crores versus 880 crores that was there last year. Even if you look at the balance sheet, the short-term borrowings now stand at just 288 crores versus 3007 crores that was there last year. Now, of course, the company has a lot of breakup when it comes to debt, but the overall short-term debt has reduced sizably for the company. Another positive in the numbers is that the EBITDA, or the operating profit, is positive this time at 38 crores versus a loss reported last year. In terms of revenues, yes, there is a decline. It is 842 crores versus 1419 crores last year, but that is what we were expecting given the fact that the company has reduced their operations also sizably. Another important thing to note is, remember in October 7th, the company had announced a restructuring wherein they decided to let go of around 11,800 crore worth of debt to one of their other units. They have announced that now. They say that they're going to demerge the SEZ unit and transfer around 11,800 crore worth of debt. So everything looking positive for Prakash Associates. The debt coming down is the key positive. Back to you.
Okay, Varinder, Fortis.
Well, we were waiting for what happens to, the stake sale and all. In an interesting development, Fortis is saying that they will be acquiring the entire stake of their Singapore listed entity by the name of RHT Health Trust, and the entire enterprise value of this entity is 4,650 crores, which also include debt of nearly 1152 crores. Now, this is a related party transaction. Of course, there will be an exclusivity period for the next 60 days. The important thing is, which Fortis clearly says, is that because they were giving a lot of service fees to the Singapore entity, which was around 272 crores, that they will not have to go when the entire consolidation happens. The India and the Singapore unit, it gets consolidated together. So the EBITDA impact for Fortis could be 272 crores plus, because they will be, they will not have to pay the service fees. The important thing is where the money will come from, because they have to pay the money. Now, Fortis has an enabling resolution to raise up to 5,000 crores. Let's see who invests in this company or not. This is only a exclusivity agreement. This is not a done deal yet. I'll be waiting out for how Fortis raises that kind of money. 5,000 crores or up to 5,000 crores is a big money, but this is the latest development which is coming.
Oh, yes, a lot of people have been stuck in Fortis. It's a stock which has done absolutely nothing, in fact destroyed some shareholder wealth. Let's move on. Look at the chart on Fortis. Abhishek, Corporation Bank.
Well, weak set of numbers coming in from Corporation Bank. It has reported net loss for the first time in 6 quarters. That is because provisions remained elevated. So your annualized credit cost was at 7.9%. That compares to about 4.5% on a quarter-on-quarter basis. The good part is the asset quality improved. So gross NPA was down 4.7% on a quarter-on-quarter basis. And even as a percentage, the gross NPA was down to 15.3% versus 15.5% quarter-on-quarter. So expect the stock to be weak in trade today.
Okay, that's Corporation Bank. Well, if you're looking at a hat-trick of decent numbers post-market hours yesterday, the big ones, then along with Sun Pharma, BOB, GAIL, is it completing that hat-trick or not, Varinder?
Well, yes, 20% beat in terms of profits, margins expanding by nearly 100 basis points compared to what we were expecting. Even EBITDA was nearly 100 crores higher. Why? Because there was volume beat on all the segments, especially the gas transmission, and of course the transmission tariff and the marketing margins were better. Operating costs also curtailed and led to all this strong set of numbers from GAIL.
Okay, Anisha, NBCC.
Well, I'm going for green for this one, given the fact that the margins have expanded and led to the profit beat. Now, the profit came at 74 crores versus expectation of 69 odd crores. Margins expanded 180 basis points, and this is despite employee costs going up sizably and an expected credit loss provision of 22 odd crores. Now, the margin expansion was led by the PMC segment of the company, 17% margin. But I would want to know from the management if that is an aberration of sorts, because they have been guiding for 8 to 10% margin band there. And the only dampening factor in the results is the revenue, because that is down about 10% for the half year as well. It has declined. The Street is factoring a 20 to 30% growth on the top line. If that doesn't come through, that will be a disappointment. Back to you.
Okay. Well, thanks for that. Varinder, back to you. Oil and gas again, MRPL.
Weak set of numbers. The numbers were boosted by inventory gains. The core GRMs at $5.3 per barrel compared to $6.5 per barrel quarter-on-quarter. And importantly, the crude throughput was down 11% quarter-on-quarter. So weak set of numbers.
Okay, that's weak again. And finally, the one that's really going to dominate Mindspace today, all those global commodities. Manisha, there's a bear ride there.
Well, it sure is, yeah, and a heavy amount of profit taking coming in for the metal space. Everything that you see in the ferrous and the non-ferrous space is trading in the red, whether it's the steel prices down 2% or the nickel prices, which actually had been the outperformer on the higher side for last month and quarter, is declined by 6% overnight, and Shanghai as well has opened quite on the lower side. It actually is starting from the Asian markets, where you have the copper and the zinc prices trading 2% down as well. Actually, most commodities in the Shanghai exchange as of now are trading in the negative. The other one to watch out for, of course, is the rubber prices. That has been on a downtrend anyways, but we have opened Shanghai nearly 5% down onto that one as well. So everywhere you look in sense of commodities in China is on the weaker side, given the fact that we have seen all weak Chinese numbers in last 24 hours. Okay, all right, Manisha, thanks very much for that. So that's bearish commodity cues overall. But how have the tire stocks done? Let's find out. We have Naveen joining in. CEAT and JK, how do the numbers look?
So remember, after the dismal quarter 1, some bit of a breather for these tire companies. I'll begin with CEAT, which has given better numbers. So margins have come in at 11.5% versus an expected 9.5%. On a year-on-year basis, it's a tad bit lower versus 13%. On the other hand, if you see revenue, that has jumped by close to 7%. Remember, for CEAT, the volume growth, that has been driving the overall revenues. Gross margins, they have plummeted, but the company has been able to improve their other expenses to sales ratio. So I expect a green on CEAT. On the other hand, JK Tyre, a bit of a mixed bag. If you see, the revenue has grown by 7% versus an expected growth of 9%. Margins have come in at 9.5%. Remember, Street was also expecting a 9.5% in terms of the margins. PAT number, it's at around 90% down at around 10 crore rupees. But remember, apart from these numbers, these are backdated. But the Shanghai, as Manisha had pointed out, the Shanghai rubber price is plummeting by close to 5%. That will come as an added benefit for the stock. Expect both these stocks to be in green in today's trade.
Okay, Naveen, thanks a lot for that. Just keep in mind that in the past, sometimes we've seen profit taking in CEAT even after good numbers. So F&O stock as well. So just wanted to remind that. But Naveen, what about Infibeam?
Infibeam also good set of numbers, Anuj. If you see the company's mix, that is their product mix, that has been moving more towards the sale of their product business, that is the application, and that has been driving the revenues as well as margins. So the revenue growth whopping 76% on a year-on-year basis. Margins have come in at 18.5% versus 14%, and the losses in their sale of product business, that has been reducing. So overall good set of numbers. Expect a green on Infibeam in today's trade.
All right. Thanks for that.